Good afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm part of the investments team that manages the Westwood Select Equity. Today, we wanted to take this opportunity to talk about our outlook for 2022, the opportunities we are seeing, what risks are out there, and how does it compare versus 2021. For that, we have Leah Bennett and Adrian Helford joining us on the call as well. Leah is the president of Westwood Wealth Management Houston and is the lead PM on Select Equity. Adrian is a senior vice president and the director of multi-asset portfolios. He's also an expert on macroeconomics. Hi, Leah and Adrian. How are you doing?
Very well, thank you.
Thank you so much.
So let's get started and let's talk about the markets. So over the last 3 years, we have seen on average 20% plus return for each year. So that is a very terrific performance by market overall. Where do we go from here? Is there any upside? What kind of opportunities are you seeing?
Yeah, so I think this is actually it's a great question, and it's interesting to see how the markets have gotten started this year. We are seeing more volatility. I think the question is what happens with the 10-year as we get into a more normalized environment. So it's been kind of fascinating to see the mutation of the COVID virus, and we've kind of gotten to a state where we're seeing a mutation. This current mutation is one that kind of lives in the nasal passages and isn't bonding with lungs, so it's moving more and more towards a cold-like status. So I think the market's starting to look beyond this. What does long-term inflation look like? How sticky is wage inflation? That's certainly been an area as we're starting to see companies start reporting earnings where we're seeing as a few surprises, and we're also getting this violent rotation in the market between value and growth. And for those of you all who don't think about value and growth as it relates to interest rates, as interest rates start moving up, a growth company, so somebody whose valuation is really based on future cash flows, the higher the growth rate potential, usually the more sensitivity you have with rising interest rates. So it's basically the present value of those cash flows. As interest rates moved up, your risk-free rate of return is higher, and so you have more stability and more visibility around how much you could make currently versus maybe a Tesla that has 20% projected growth, but that volatility associated. So you have people who start rotating out of growth and into value. And you're seeing that violently happen in the market. I think today marks the period where the NASDAQ has officially hit correction status. We have more than a 10% correction at this point. We saw this happen in April. We saw the 10-year get up to like 1.85% and then retreat based off the Delta variant, and this time we don't seem to have that same headwind if the virus continues to mutate in a less difficult way for society. So it's going to be interesting to see if we move on to 2%, or if you start seeing some stability in the growth stocks. Another big trend that I think we'll see this year is merger and acquisition activity. So if you look in 2020, one of the hallmarks that year is obviously interest rates collapsed to near zero. And the S&P 500 companies added about 30% in cash to their balance sheet. So everybody went out and raised a bunch of debt. And you're starting to see some of that money put back to work. So Microsoft's announcement to buy Activision and the acquisition of Cerner, you're starting to see more money deployed. And I think those are positives in the market, but certainly don't see the same market on the equity side that we've seen in the last couple of years. Adrian, would love to know your thoughts.
Great, thanks. That's very much in keeping with mine as well, where I think about interest rates being one of the key drivers. And as you talk about, just to reiterate that, interest rates have two impacts. Number one is they make your longer term cash flows more uncertain, more volatile. So things like Tesla, where the expectation is that these cars are going to be driving around in the air like Blade Runner 2054 with Tesla on the side, producing cash flows well into the future, it makes that less uncertain and you discount those at a higher rate. Thus, the growthy orientation is less likely to perform when interest rates are rising. I think similarly on that front. I'd go back and say just, your top line question, the last 3 years have been extraordinary. Hasn't been just the last 3 years. The last 13 years have been extraordinary, where we've seen an average return of the S&P 500 of around 16.5%. And the only blip in that cycle was that last quarter of 2018. 2018 was the only negative year, just based on really December of 2018, where guess what happened? That was when we were looking to tighten monetary policy, and there was a concern that we were going to tighten monetary policy. Thus, in December, the market sold off by 9%, which was an extraordinary amount. Thus, of course, our antenna are up for we're going once again into a hiking cycle, and the Fed is somewhat of pulling the punch bowl. This gives us a little bit more pause, a little bit more expectation that equity returns are going to be more muted than in the past. That said, corporate earnings will drive. We're going through an earnings season right now, so we'll start to see whether our forecast of 7.5% for 2022 comes to fruition. The consensus right now has been running around 10.5 to 11%. Still positive, but certainly not the eye-popping returns that we've seen over the last 13 years, and not 2021. We don't think it'll be based on multiple expansion of the excitement of growth in the future. We think it will be on, as Leah is pointing to, the realization of near-term earnings profiles. But we do see positive returns for the year.
Yeah, and I do think leveraging off one of your points, I do think that something that's important is, as we're coming out of COVID, you do have some companies that have really ripped out their expenses, and they become much more profitable. And that's a secular change that I think will last for a while, but that's very company specific and less kind of the broader markets. But I do think some of those things are going to continue to play out.
Agreed. And that's going to be a nice buffer for some of these companies that, the other side of that is labor cost. And as they see labor cost, yes, they've been able to right size their cost structure a little more. They've been able to pull forward some of the technology that allows them for more productivity with hopefully a lower cost structure. On the other side of that we'll see inflation, and that's something we're watching for as well.
Thank you so much, Leah and Adrian. Super helpful. And just to follow up more, so which asset classes and sectors, of course, technology has been a leader for the last few years overall, but which asset classes and sectors do you think are the most, have the most upside? And on the other hand, which asset classes or sectors do you think have the highest risk exposure?
Sure. I think it's a good year for rotation and for active selection. One thing that Leah and I were just talking about is maybe the environment is less the kind of beta environment of just hoping that all companies will do well, and more the environment of let's pick the right ones that are going to produce good earnings profiles. But just starting at the asset class level, how do investors right now want to be positioned in a rising rate environment after what we've gone through? Last year, I will say, was extraordinarily disappointing for the emerging markets. And maybe a little bit of that was a COVID delay in vaccine. If you're in the United States, you can get a vaccine if you want a vaccine. Maybe not so much if you're in Peru, or if you're in some of these productive environments in the emerging markets. That's starting to right size a little bit. And it's a rarity where we see commodity markets. Copper was up over 20% last year. Oil was up 60-some% last year. Yet the emerging markets did poorly, partly because of that, partly because, of course, the regulatory regime in China, which is, we think, relaxing some. So there is going to be an opportunity this year for investment in that area. I think that's likely the second half of the year, once we see maybe a tailoring of the interest rate expectation come off. So that's one area investors should look at and make sure they have exposure to. Now, on the sector side of it, Leah pointed to looking at sectors that have some resilience to interest rates rising, to the cash flow discounting. The first half of this year may as well be a little bit more volatile as we start to estimate what prospective growth impacts are going to be of a rising interest rate environment, of the central bank reacting. This is one reason why we've seen the consumer cyclical sector not do so well at the very beginning of the year. That said, some of those areas can start to right size, and we've seen that already in earnings of luxury goods that are doing, like Burberry, that are doing very well. Other areas are energy, of course, and financials. These are companies that, boy, on the energy side, they have been downtrodden for some time. One of the complaints around the energy companies is a misallocation of capital. That's been years in the coming, and so we've seen better allocation of capital. We see more cash flow production, and these companies are now more cash flow positive, cash generative. Whether West Texas Intermediate oil is at $75 a barrel or at $40 a barrel, at this point they're able to be more cash generative than in the past. So we see opportunity there still. The last bit is on the bond holdings. Do investors? We're talking about interest rates rising. When interest rates rise, of course, existing bond prices go down. So do investors sell their bond holdings? They are not going to be selling their bond holdings to zero, as the insurance policy of holding them, should we see a significant downturn, does still exist. You hold them for two reasons. You hold them for the income and for the insurance policy. The income is pretty skinny. We know is a U.S. government bond is around 1.8%. But the insurance policy that prices might go up should we see a significant sell-off still exist. And it increasingly exists as we get closer to a more volatile environment. So investors may reduce their holdings or find alternative income in other places. We think that's a positive place to do that. But at the same time, they'll probably still have some bond holdings.
Yeah, I think something else that really became more important during the fourth quarter, and I think will continue to be important, is quality. There's definitely, as there's more uncertainty in the environment, people have really been migrating more towards quality companies, better balance sheets. That really started in November or so and has continued through January so far. And I think that will continue to be a theme, regardless of what sector we're talking about from a thematic perspective. I do echo some of Adrian's comments. I think financials are really interesting. They've been beat up. They should benefit from a steepening yield curve, which is what we're talking about when we're talking about the 10-year starting to recover and interest rates getting up to a more normalized level. With that, there is and we've seen this in earnings, as I referenced earlier, we're starting to see increases in wages really come through, and to some extent even more so than what the market expected. So that's the offset there. But I do think financials are interesting, and their valuations kind of reflect some of those uncertainties. Industrials and materials are also really interesting as we're coming out of this. I think industrials have been pretty beaten up during this correction. I think we're starting to find some nice opportunities there. And then I also think this is a period where we're going to see a lot more geopolitical risk. And I've already started seeing more geopolitical risk than we have in the last couple of years. And with that gets to Adrian's point. That's another reason why to have some energy, why you should have some energy in your portfolio. It's also why I think small caps remain attractive. So I do think companies that are more domestic they're shielded a little bit more from some of the issues in China and with Russia and Ukraine. So I think that's an area, and certainly valuations are more attractive this month than they were in December. So that's an area that I like as well.
Thank you so much. Super helpful. And Adrian, just to dig down further into the rate hikes. So as of yesterday, market is now pricing in at least 4 rate hikes. What do you think is the likelihood of that happening, that by year end the rates are at 1%? And how does it impact different asset classes?
Sure, that really is one of the bigger questions that all of us armchair central bankers are trying to tackle right now, is how much can they do? How much? I often think of the equity markets as a pressure valve that allows us to right size some of the economic growth and the prospective economic growth. So how much can they actually do? Just in context, in October of 2021, we were pricing in just one hike. At the end of the year, we were pricing in 2.5 hikes. Now all of a sudden we're pricing in, just since the end of the year, we're pricing in 4 hikes. In 19 days, the prospective economic growth hasn't gone up so dramatically that it's allowed that. It's more that the reaction mechanism of the central bankers in tackling inflation that we're starting to see, as well as them right-sizing policy, has changed dramatically. Now, the question also is, we were pricing a little bit over 4 hikes. 4 hikes means we're hiking 125 basis point hike every single quarter, whereas in the past, 2004 to 2006, we doubled that rate for 2+ years. We went from 1% to 5.25% in 2 years. So since 2006, we've had two different market crises. We've continually heard from the Fed that we're going to remain lower for longer, let the economy run hot, kind of a mantra. I think generally the Fed will be more sensitive to the reaction of the equity market, and should we see a significant sell-off related to this, then they're going to slow that mechanism down as the equity market is a pressure valve. It might even be sort of a third mandate of it's the wealth effect that they are reining in a little bit. So I think we could potentially see 3 to 4 hikes. My current call is for 3 hikes, as the likelihood is that we're going to see volatility over the course of the year, and we're going to start to see Fed governors talk down a little bit that they're going to be accommodative to markets. That said, it's possible that we do so, and long term for the economy, it would be a good thing if we were able to hike 4 times, because it would add comfort level to central bankers and to the broad market to be able to control the next downturn in a cyclical economy.
Thank you. And I definitely agree with you on that. It gives the Fed Reserve the cushion to control in the future. So let's talk about inflation. It goes hand in hand with the rate hikes, and that is something that is on top of our clients' minds. So in December, we saw the headline inflation number at 7%. This is the highest since summer of 1982. How do you think it's different this time versus what we saw in late 70s and early 80s?
So I do think this is a very different period, and it's going to be interesting to see what kind of the long-term consequences as we come out of this 2-year period. And I know we've talked about this before. We've never really stopped the global economy and restarted it 2 years later. I mean, it's hard to believe that we've been in this for this long of a time frame. So I do think there's a couple things that are going on near term. Obviously, we've talked about their supply chain issues. It's funny, I flew yesterday. You talk about that the airlines are canceling flights every day because we do have this still major wave of COVID going through. And so you've had a period, especially over the last year, where you're having really a pickup in demand and people starting to get out and do things. And so demand is increasing. Even consumer spending you see is up, I think 11% versus where it was pre-COVID. But on the supply side, you are still seeing some serious challenges. And so that mismatch is certainly an issue. And I think there's kind of multiple dynamics in here, because we can certainly talk about the deficit being part of this, and the cost of inflating or getting the economy through this is part of the challenge as well. But just from a supply demand perspective, you've got this major imbalance. And so one of the questions I have is, as we actually emerge from this period, you could see a reversal where you see demand start kind of more normalizing, and you start seeing supply start increasing a fair amount. And then with the pull through of technology, it's going to be interesting to see what happens from a normalization perspective. I think that will be helpful, but I'm really worried about the wage inflation and how sticky that is. I mean, I think that is definitely a risk. It's also important, I think, if you're looking at this period versus periods in the past, how global the economy is. And just an example to kind of show is, it used to be the cheapest place to outsource was to China. And because of the one child policy there, you started running into an issue. And again, when we're talking about inflation, supply demand, where supply, the workforce was really more limited. And so prices started going up from a wage perspective. And then you started seeing all this outsourcing down to Vietnam and eventually over to Mexico as energy prices have come down over the last few years. So I think you also have situations, because the world is more global, we're able to find additional capacity than what we found in the past. So again, I'm less concerned about, I would say, really high levels of inflation, but I do think we're going to get back to a more normalized state.
Very good points. I mean, one thing I'm often looking at is this discussion around whether we are in a wage price spiral, i.e. wages are going up. Consequently, people are spending and prices go up and potentially go up even further, which, of course, back to basic principles of why is inflation a deleterious effect? It's a deleterious effect because it erodes your consumption power, it erodes your pricing power. It also erodes the value of your debt that you have on your balance sheet. That could be positive for some. It's not so good for the banks that hold the debt and others that hold the debt, but it could be positive and negative. But the inflation itself and having a base level of inflation it's starting to go beyond, I think, what the Fed's comfort level is, and thus we're questioning whether we are in a wage price spiral a la late 1970s, early 1980s, for which we saw considerable inflation, and then we had Chairman Volcker that reined it in with interest rate hikes that reined in the economy and led to a recession. Things that we're going to be watching for this are things like the employment cost index that's coming out shortly. As Leah is mentioning, we are fundamental at nature, and so we are looking for what the CEOs and CFOs are telling us about their own cost structure. We've only in this price cycle, we've only really seen the banks that have started to come out and talk about this. PNC just came out and called it the Great Resignation of, why is supply so low right now? They're trying to find jobs, and if you look in any restaurant window now, you are seeing for sure that they're looking for people to hire. Your food is coming slower because people are trying to manage more tables. PNC called this the Great Resignation because more people are sidelined, or maybe they've resigned simply because their house values have gone up so much they've been able to retire early. They expect this to persist as well, as do others. We're seeing First Republic Bank that came out and said they've hiked up their minimum wage to $30 an hour. So we're seeing base wages that are $20 to $30 an hour to attract the workforce back. Generally, there's enough deflationary push. We think that by mid-year we're going to see that high inflation aspect come down. One of these is, as Leah's talking about, that we'll see a little bit of a relaxation in that supply and demand imbalance in the labor markets. One of these, of course, is that we've just gone through a holiday season and coming through Chinese New Year, where you see more shipping and more supply chain problems, and that's led to inflation as goods have become harder to come by. We're going to see that roll off a little bit. Corporations have been building up their inventories because of the supply chain problems. So they've been, if you imagine the warehouse where they're expecting to sell toys, they've been building up the toys so they can provide them to their customers. As they've built up enough toys, as the inventories have built, they start to sell those. No longer do they need to advance orders, which is an inflationary impact. We have less of that concern. Finally, of course, we're raising rates, and raising rates to control inflation. We will see the impact of that take hold some, and that will help. By mid-year, by late 2022, we should start to see the inflation metrics that are really elevated.
And to kind of add on points real quick on to Adrian's comments, which are so true, especially on the Great Resignation. It is interesting to see people are making lifestyle choices and lifestyle changes. They really had an opportunity from working from home of is this company I really want to be with? Do I want to be doing something else? And you kind of see that with Uber drivers, and I think it's so interesting. Uber and Lyft prices have gone up so much because so many people have chosen not to have that, not to drive for them anymore. And so drivers are moving to Amazon, and they're moving to Shipt. And the lifestyle part of that is they could make smaller trips back and forth. They're not driving their own car. They can get out more. So it's better health-wise. It's less wear and tear on their vehicle. But it's interesting. I think that's kind of a microcosm of what's going on from a global perspective. So again, getting back into, I think it's naive to think the world is going to get back to where it was pre-pandemic. I just think the world is going to be really different. And that's what's exciting from an investment perspective. And to Adrian's point of thinking about the Fed continuing to increase and how much are we going to increase? Is it going to be 3 or 4 times? It is interesting because in the recent past, that fourth quarter of 2018 that Adrian mentioned, the Fed raised one too many times. And I think one of the lessons there, and of course the market contracted by about 20%. And one of the lessons they talked about is being much more data specific. So I just think that's a recent opportunity that will hopefully drive the decision about how quickly to raise rates and to really pause at the right times.
Thank you so much. Super helpful. And my last question, let's shift our focus from, macroeconomics to geopolitical concerns. Everybody's talking about rate hikes and what Fed Reserve will do, what will happen to inflation. But what kind of uncertainty do you think there are with the geopolitical situations? And is there anything that you are particularly concerned about that you think will have an impact on the markets?
Sure, I'll start. And as an old fixed income investor, I'm always concerned about 50 different things. One of these is geopolitical, and it's an ever-present risk. It's also kind of an unknown unknown as well as a known unknown. The known unknown right now is Russia and the Ukraine, and what the proclivity for Vladimir Putin to invade Ukraine is, and what that probability is, and what that impact is. It's hard to say what exactly he's thinking, but we know for sure that he's pushing the line very close with over 100,000 troops on the border, putting more into Belarus on the border there. It looks like the likelihood is that he wants to get a little bit of the band back together as far as the old countries of Russia, and that may be taking eastern Ukraine. Of course, that's combating against the push of NATO to be anywhere near the border. And he's making these strong cases to try and do that more as a strong man. The impact of all that happening is if he invades eastern Ukraine, that's kind of what's expected right now, and I believe that is what the markets are pricing in. Then it's unlikely that there's going to be a very strong reaction if he's not moving towards Kiev. I think the initial response will be more concerning. The longer term response is that they probably start pumping gas and oil again, because there is a concern from the supply element of Europe, which of course is in winter right now, and they need that heating material for them. So there's probably not much of a response there. If he goes further out of that and tries to really get the band back together as far as bringing in the whole of Ukraine, that is unexpected, and that would lead to, I'd say, significant volatility in the markets while we reevaluate what the response looks like. Are there opportunities there as far as how we position our portfolios? Leah mentioned the energy sector. It's potential that we're going to see some concern that maybe with restrictions on Russian oil and gas, if there is a response there, then that leads to higher oil prices. Lower supply means higher demand. At the same demand means higher prices. It also means that maybe we see more defense spending in the upcoming budget, as there is a concern of what this leads to. And for that reason, then we can see more spending put into the budget on the back of that.
Yeah, I think it highlights. I think risk management always is important. Risk management, I think, will be even more relevant this year than it has been in 2021 and the second part of 2020. So I think that's going to be a more relevant theme of really being thoughtful about how you're approaching your portfolios. It seems like the last 2 years, we've really focused as a global society on fighting COVID, and now that the outlook is starting to improve, we're kind of looking at our neighbors and starting some fights there. So it just seems like people's focus is kind of changing a bit. I do agree with Adrian's thoughts that if we see the expected outcome, having some exposure to energy makes sense. But also, they're not large global economies, and so I do think it would be more contained as far as what collateral damage might be on the global economy and on the markets. I do worry a lot about China. China is the second largest consumer globally and is very levered. And obviously, there's concerns about the relationship with Taiwan and with Hong Kong. And so that's definitely a concern that I have that would have major ramifications. So again, those are things that we talk about a lot. And I do think risk management is a key part of our DNA and how we approach things. And I think that's something that just will continue to be relevant this year.
Thank you so much, Leah and Adrian. These are all the questions I had. Thank you, everybody, for joining. Please feel free to reach out to your advisor if you have any questions. We hope you have a wonderful rest of the day. Goodbye.